Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have back with us Fort Worth financial professional Guy McCord, and we'll be talking about the myths of life insurance. Guy, welcome back to the program.
Hey, Mike. Great to be back. How you doing today?
Doing awesome. And I think we have about a 9-hour episode if we're talking about the myths of life insurance. So I know we would just want to kind of touch on the low-hanging fruit and clarify some of these things. But first of all, why are there myths about life insurance? Where does that start, do you think? Because I know that when you say the word life insurance, people's red flags go up. So let's get started with why is that?
Well, I think, Mike, it's because, at least 60% of Americans are underinsured or not insured for life insurance. And, there's a lot of myths about, how much does it cost? Most Americans think that it's about 3 to 4 times more than it really costs. And, essentially, what is life insurance? It's not, when you buy life insurance per se, it's not an emotional decision. It's just a risk management decision, and it really protects you against 5 simple different risks. The first one would be mortality, which would be like term life insurance at its simple form would be pure risk. Term is a pure risk, what they call a pure risk product, protecting you against death or disability. The second one would be morbidity, which is like disease. And most of the life insurance carrier companies out there have what's called a critical illness rider on there. So if you get cancer or if you get something that's going to cause you to die within 12 months, it's imminent, it'll protect you against that. Thirdly, it covers you against longevity. Americans are living longer and longer and longer. I have lots of clients that are living well into their 90s. So it covers you if you live beyond your income generating capacity. Some things that can do that are annuities and long-term guaranteed returns. The fourth thing it would help you with on risk would be market volatility. You can get guaranteed returns on a participating or non-participating products that you're going to get a return when the market goes up, but you're not going to lose money when the market goes down. And then finally, financial discipline. It's protecting money from consumerism and a lack of discipline. So it really protects against those 5 different things.
Those are huge points that I think a lot of people don't think about. And I think that most of the time people think, mom, dad, grandma told me to get life insurance. So let me just get it. So let me just go to the place that I normally go to Google. And let me just Google this. And then I'm going to do what I'm normally conditioned to do, which is find the cheapest thing and then click buy. Why is that a mistake?
Well, the cheapest, it's like anything else. In life, at least in this country, you get the old proverb, you get what you pay for.
Yep.
Sometimes you get what you pay for, sometimes you don't. But if you're dealing with a reputable advisor and you typically, I don't like to write companies that are anything less than an A-rated carrier. And when I mean, how's it rated? Well, there's 3 or 4 different rating services that rate carriers based on their financial strength, based on their ability to pay claims, and so forth. So let me jump right into some of the myths. Okay, I know of about 9 or 10 myths. I'm just going to do as many as we can do in this call. Try to keep it simple and keep it quick. But the first myth is that life insurance is only useful after you die. Okay. Okay. So that's really a myth, because in the last 5 to 10 years, like I said previously, carriers have, the markets always are changing, right? That's one thing we know, is that the world is always changing. Okay. So many years ago, life insurance was just about dying. But now, like I said, it's about many of these policies have critical illness riders. For example, if a person can't do two or more of what we call the activities of daily living, the policy can kick in and start to pay. And many of them have what's called a terminal illness rider. If you're projected and you get a letter from your doctor saying you're going to die in 12 months, you can get 90% of your money out, or if not all of your money out of whatever the death benefit would be. Really, the second myth is, well, I've got, I work and my company covers me, so I don't need another policy. Okay. Well, that's that. The thing about employer provided what's called group life insurance is that the coverage only lasts while you're working for that company. Okay. If you terminate your employment for any reason, usually your coverage goes away. And what a lot of my clients that catch me later in life after they've started to retire is that they could have become uninsurable or have so many health conditions, because our health is never better than it is now, because as we age, our health is always going to decline in most cases. I do have a 92-year-old client that plays golf every Monday and Friday, and he's as fit. I mean, he looks like a Navy officer. He's perfectly fit. He just out there. He said, "I'm going to live a long life, and I'm going to enjoy it, and I'm going to stay healthy." And playing golf on Mondays and Fridays is the way he does that. And he's still got all his faculties. He's just a super guy, because most of my clients, what I tell them when they retire, I'm like, "What's your life going to be like in retirement? Are you just going to hang it up and sit on the couch and watch TV, or are you going to enjoy life?" And I've got one client that's 72 years old. She's got $500,000 in a guaranteed account, where whenever she decides, she works as a travel nurse. So she'll go on job assignments all over the country for 90 days apiece. And if she doesn't like that job at the end of 90 days, she just doesn't go back. She goes somewhere else. But I've told her, I said, "Look, you like work." She's a neonatal respiratory therapist and speaks Spanish from Mexico, but she lives here. She's a Texan. And she loves working with the doctors, because she says, I said, "Why do you like work? Do you just like working with the babies?" And she goes, "Yeah, I do. I like that. But I like working with the doctors because they listen to me." And I'm like, "Okay." So she's 72 years old. She's still traveling every 9 days. She's active life. And I said, "Well, she has no kids. She never had children." I said, when do you want to sit on the couch and watch TV? And she says, "Never." And I said, "Okay, well, it's going to be highly unlikely you're going to be able to work into your 90s. But whenever you're ready to turn on your income flow, we can do that. And we will have you guaranteed income till the day you die. If you live to 120, you're going to have a guaranteed income." Now, that's a myth that people don't understand. That, for example, a fixed indexed annuity has the ability to pay somebody until they die. And even if their account balance is zero, they will still get that check. Okay, so.
Guy, that's a couple of points that made me think of a comment/question for you. It reminds me of, like, when you think of real estate, rent versus buy. If you rent a house and 5 years later you move, you have nothing to show for your money. You just paid the landlord your rent. But if you buy a house, you've got tax deduction, you've got equity buildup. So it's kind of like term life insurance is renting, because you don't have any benefit, and those don't provide those things that you've just described, some of those living benefits. Because I think that myth of people thinking life insurance kicks in when I die. Well, I don't get any benefit. I'm still living. Well, yeah, you do. And those are a couple really big ones there that you've just mentioned, is being able to access that life insurance even when you're alive. Those are some great living benefits.
Correct. Like the third myth would be, "Why do I need life insurance? I'm young, single, healthy." Okay. Well, life insurance is the one product that can't be bought when you need it. In other words, if your house is on fire, you can't buy a fire insurance policy, right?
Yep.
So same thing with life insurance. You buy it when you're healthy because the rates are going to be, and younger because the rates are going to be less. The fourth myth is life insurance is expensive. Okay. Um, and like I've already said, most Americans actually think that it's 3 to 4 times more money than it really costs. Um, so the fifth myth would be, term insurance is the only form of life insurance. Well, that's just not true. Term insurance, like you said, Mike, is like renting your house. Okay. When you have a term policy, it's set for 10, 15, 20, 30 years. And once you've paid all the premium over that term, you're done, right? You have no more benefit. But you're not paying any more premiums. But you've rented that policy for the term, kind of like leasing a car. You lease a car at the end of the contract. You turn the car
turn
in,
it back in,
or buy it, right? Anyway,
now one thing that I think is important too here, and correct me if I'm wrong, people comparing premiums for term versus whole life. It's going to be cheaper for term, so it is going to be more expensive on whole life. But when you get all these living benefits you've been describing, as well as other things like buildup of cash value and dividends and all that, be prepared that it's going to be a little bit more expensive, but it comes with so much more value, right?
Well, I use you mentioned whole life. Okay, now whole life is, I would say, with most carriers, probably the most expensive way to buy life insurance. And why is that? Because it covers your whole life. It never, if you're paying the premiums and the policy is funded, it never lapses, and you'll have a death benefit if you live to 130 years old. So I only use whole life with selected clients where it's appropriate. Okay, and there's specific reasons. They're way too complicated to get into on this call. But yeah, whole life I use it rarely. But I do use it, but only when it's appropriate for that client for their specific application. Okay, there are other forms of coverage like universal indexed life. Where the money in the account, what it is, it's you have and what we would do is design a policy that's what we call fully funded with the minimal death benefit that you can buy under the IRS tax code in order for it to not become what's called a modified endowment contract, which is taxable. So the great thing about life insurance is it falls under the tax code called 7702. It's where you can, like an IUL, an index universal life policy, you can dump money into that policy with the minimal death benefit allowable under law in order to park money in there to get indexed returns and protect that account. So, unfortunately, there are many advisors that improperly design those types of accounts. And if it's not done properly, you could take a bath. And so the key thing is always to set the assumptions properly. The old proverb is under promise and over deliver. If you have an ethical advisor that does that, that's not just trying to get paid, but is actually setting up what's best for the client over the long term, given any type of market considerations, that can greatly benefit the client on their wealth building. Okay. It's kind of funny because most of wealthy Americans, and I'm talking about the top 5%, use index universal life because it's just a superior vehicle. The next thing would be I'm not eligible for insurance because I'm too old or I have a pre-existing condition. Okay. Life insurance rates are designed based on averages on mortality, averages on height and weight, averages on health considerations, age. So when we have a client that's got certain risks, let's say they have diabetes, for example, they can in most cases still get life insurance. It's just going to be rated differently based on their
Yeah.
specific health conditions. Okay. Another myth. I will get better returns from investments other than life insurance. Okay. Well, let me ask you this. When you do comparisons of accounts or products, you should do apples to apples, not apples to oranges. So, in other words, let me explain that. Would you ever compare, getting your smartphone and comparing that, taking your smartphone apart and looking at the components like the phone, the camera, the hard disk, the browser? No, you wouldn't compare those because those are apples and oranges. You would want to compare smartphone to smartphone. So the same thing is like that with life insurance accounts. And so we want to make sure that we're comparing the right thing. Okay.
And you're not saying put all your money in that. You're just saying use this as a tool.
Yeah. I would never say put all your money in one basket, all your eggs in one basket. Life insurance should be a component of the investment portfolio, not all or nothing. Okay.
Yep. Guy, regarding the health insurance point that you made, isn't it true that in a permanent policy, like you were mentioning, like you said, it covers your whole life, or it's a permanent policy? You don't need to get re-examined in a period of time. Whereas in whole life or term life, if you got a 10-year term or 15, you've got to requalify. So you might have your health change in that time frame and now might have extremely high premiums or not get coverage. Whereas in that permanent policy, once it's set, you've got it till you die.
Exactly.
That's a big piece.
Yeah, you hit the nail on the head. I would say probably the last myth is that, filing a claim's a hassle and that the insurance company can deny paying out the beneficiary or hold back money. That's really a myth, because most states have a 1 or 2 year what's called the fraud clause. Let's say a client made a material misstatement or just flat out lied on their application. Well, I'm based in Texas, and for example, Texas has a 2-year window from the date that the policy is issued. So let's say I bought a life insurance policy and I lied, and the insurance company did not uncover my lie. Well, the carrier under Texas law, and a lot of other states, it's 2 years or 1 year. They have that 2-year window to either uncover that misstatement or terminate the policy, or if they've taken my premium beyond the 24th month, then they're stuck with me and I got away with it. I'm not telling clients to do that. Yep. That's theft. That's fraud. But let's, for example, somebody's, a guy commits suicide. Well, if he does that in the first 2 years, it's called the suicide clause. The carrier under Texas law is not going to pay. But if he gets to month 25 and does it, the carrier has to pay, regardless of what he did, because they've lived and taken those premium payments beyond that 2-year window.
That's a good clarification. I think there's so many points that people just, if you were to, you hold up those, you see in the movies, those Rorschach tests, like, oh, tell me what you see here, tell me what you see here, or what's the first thing you think about when you hear the word whatever. Well, I think that, like we started off this conversation, when you hear the word life insurance, people are like, red flag. Well, you've brought up some huge opportunities for clarification. You clearly let people realize that, hey, here's a myth, but that's not the case. Hey, here's a myth, and here's how it really works. So there's a lot of choices here. And like you said, under the permanent type of policies, there's so many variations: index universal or permanent, and all these different whole life, these different ones to see what might be the best fit. It's not the best fit for everyone, and we don't put all our eggs in one basket. So I just like your approach to just taking care of your clients and making sure they're getting the best thing for them. So boy, if someone is interested in learning a little bit more, what's the best way they can do that and also reach out and connect with you?
Online at Guy McCord guymccord360.com. That's GUYMCCORD360.com. And my number direct is area code 214-329-4800.
Well, Guy, it's been a real pleasure chatting with you today. Thank you so much for coming on.
Thanks for having me, Mike. Talk to you soon.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneursradio.com.